And before we dive in, actually, I'll take a step back. For those that are not as familiar with us at Lone Star Capital, my name is Rob Beardsley. I'm one of the founders of Lone Star Capital. With me here is Charles Waldron, our Director of Acquisitions, who oversees the entire acquisitions process, as well as the putting together of this data with the help of Brad Oliver, who's also on the webinar today. So thank you very much, Brad, for putting in that work. Charles, do you want to just intro yourself and then kind of share the setup that goes into this spreadsheet?
Sure, yeah. So hi, I'm Charles Waldron. I head up acquisitions here at Lone Star Capital. So, interfacing with the brokers and then bringing in the deals, reviewing them, figuring out which ones they want to bid on and at what level, and kind of guiding them through the process eventually to close. Focus on Dallas and Houston metros, as you can see here on the left in our market column. So that's just our bread and butter here. And this is kind of a review of all the stuff that we've worked on in the past quarter.
Yep. So to provide more context before we go into the insights, this spreadsheet is every single row represents a deal that we sourced and underwrote and likely put some sort of bid on, because there's no sense in going through the process of evaluating a potential deal and not providing that feedback as far as where we like the deal, right? It's good to provide the market that feedback so that sellers' pricing can adjust if it's warranted. And right now we're seeing a lot of that where people are going to market or going off market to solicit bids. And it's really important now more than ever to provide that feedback to let sellers know, hey, if your pricing expectation is here, there's actually a handful of buyers down here. So if you are a market seller, then likely you need to bring your pricing in line with where the market is. So it's good for us to be putting out that feedback, letting sellers know, hey, here's a reasonable transaction price. So as I mentioned, every single row is a deal. We have redacted or taken away some information just to retain some anonymity. But if you're familiar with these markets, I'm sure there's going to be some deals here that you can kind of pick up on and recognize. But with that being said, just to go through the various columns, we have market. So as Charles mentioned, we really focus on two markets, DFW and Houston. And it's interesting to compare the data from those two markets, because while those markets are both Texas power markets, they do have their differences. Another interesting nuance that we cover is whether a deal is marketed or off market. So here you can see market versus off market. And we'll talk about those trends when we get to that point as well. Unit size, I don't know if we'll really have that much data to talk about as far as unit size, but as you can imagine, there's definitely some insights that could be gleaned from larger unit properties versus smaller unit properties and how the cap rates and projected returns vary between those deal sizes. Similarly, we have vintage. So as you can imagine, return profiles may differ from older properties versus newer properties, and also business plans can be somewhat dictated by the vintage of a property as well. Some other important things to point out is, of course, pricing. So pricing right now is very, I would say, opaque, because we have such a wide bid-ask spread in the market today. And just to simply cover what that means, we have sellers who are looking at the past and they're placing the value of their property here based on the past, and then buyers are forward-looking, and because interest rates are higher and future performance is less certain, buyers are being more conservative, and so their prices are down here, and that's creating that bid-ask gap, which has been a recurring theme that we've been talking a lot about here in the office, as well as with investors and partners around the country. So when we have pricing here, we have the guidance pricing, which is the pricing quoted to us essentially, or the strike price as given to us by the broker or the seller. And then we have our value as far as what we think would be our price that we would pay for the asset. And then we get into valuation as it relates to these pricings. We have the underwritten cap, which is the cap rate at which we underwrite the deal at based on their strike price. And then we have yield on cost, which is the stabilized yield on cost metric, which is where we are projecting NOI can end up through the business plan, divided by the purchase price and the CapEx. And so yield on cost is a very important valuation metric, which doesn't take into account leverage, so it's less manipulatable, and it gives you a clear sense of the return potential for a deal. And then you have our pricing, which is LSC here, and it's our underwritten cap as far as our price. So just to give you an example with this first deal here, we have a 4.2 cap is what the seller essentially wants to sell the property for, and a 5.1 cap is essentially what we want to buy it for. And that's the disconnect. And that's a very wide disconnect. Normally the market is a little bit tighter than that. But if going from a 4 to a 5 is a huge disconnect, right? It's about a 20% pricing difference. And I'd say a normal healthy bid-ask spread is more like 10%. So we have twice as big of a bid-ask spread. So, and of course we have more things here, such as the projected returns based on our pricing, and the NOI that we're projecting, as well as the CapEx, which will tie into some of the insights that we have to share. So hopefully that makes sense and sets the stage for what all these numbers mean. And again, feel free to put questions in the chat, but without further ado, I'll let Charles jump into maybe the first insight.
Yeah, I guess we look at some summary stuff.
Yeah, that would be
first.
Yep.
Yeah, so we looked at, a lot of units. I think this is about 100 deals, give or take. And you can see actually just, that in terms of the vintage and the size, this quarter we've looked at the average vintage is 1986. Last quarter it was 1986. The unit count this quarter average is 247. Last quarter is 265. So square footage, both in the 800s. So kind of really similar, honestly, in terms of the deal criteria that we've been looking at. We've been pretty consistent in maintaining our box. And yeah, just a very, very similar slice of products. Although the market, in terms of where we're looking, we've kind of looked at a few more deals in Dallas this quarter. So last quarter we were 2/3 Houston and 1/3 Dallas. And then this quarter, given that, we're kind of focusing on Dallas a little more, and there's a little more activity there, I would say, is just a little bit, that we're looking at more Dallas deals as a percentage as well. So, but in terms of the product, it's really similar to last quarter. And then, yeah, you can see that, kind of going to where I was saying about the bid-ask spread and the market in this tricky place. The market's been in a kind of a funny place for a while, right? Even last quarter, it was basically half and half between marketed and off-market deals. And now at this point, I think we're at 75%.
Where did I see that? Back as far as off-market.
Yeah. Yeah, we're at 70% off-market deals for this quarter that we looked at. Which, it also just is, if they are really a serious seller, they might not be off-market. They might be in the market.
Well, why don't we jump into that as being our first real insight as far as the way that marketed deals versus off-market deals and how that has shifted from one being more attractive than the other, essentially.
Right. So yeah, if you're marketing right, everyone knows your deal is for sale. If you mess it up, it's going to be embarrassing. You're kind of putting yourself out there, and you're kind of committing to sell pretty much, at least a good amount. Last quarter there were more kind of hung processes where they called for offers, they didn't get the number they wanted, but at this point people mostly know, I think, more what's going on. And so if they're going to be in the market today, they're likely a seller.
Sorry, I'm going to find the file. Are we comfortable sharing this file or no?
We haven't been sharing it recently, I think.
Okay. All right. Yeah, we're going to hold off on sharing for now, but thank you for asking. So just to build on the off-market concept, when the market was going up and up and up, if you took your deal to market, it was more than likely to get a bidding process to ensue, and that would actually bid your property up above your strike price. You would actually sell for more than you're asking. Now that the market is not going up and up and up, now when you go to market, you really only would do so unless you are more than likely a market seller. So whereas before, the off-market deal could have been the more attractive deal because it would potentially be sheltered from an aggressive bidding process, now it's the opposite. Now the off-market deals are the less attractive deals because people who are off-market are just people who are kind of dipping their toes in the market just to see if they can get their price. Whereas market sellers, not all of them, but some of them are going to market and saying, hey, I just need to sell. I'll take whatever the market's willing to give me. And that's what we're focusing on. So what you're seeing here is only 29% of the deals that we looked at this quarter were marketed. And that's because far fewer sellers are willing to go to market, because if they don't have to sell, why would they sell into a weaker environment? But these are the ones that are more attractive to focus on, which, as again, I mentioned, is the opposite of how it was before. We were always striving to have more and more of our deal flow come from off-market sources because we felt that those could be the better opportunities. And now I'd say it's inverse. Now I'd rather have this be 70% of our deal flow. The more marketed deals we could look at, the more I'd argue we have a chance to strike.
And similarly, it used to be that no one would want to preempt the process because the price would always go up the further along you went. But today, a lot of the processes are flexible, or, if they need to see the bid sheet, that, maybe that's because they need to see a number of bids in order to take one less than really what they would like in an ideal world. So you might have seen, in the past where there would be, sorry, I'm blanking here.
It's fine.
Yeah.
Let's do,
well, we haven't, yeah. So, so the next stat on this topic about bid-ask spread is just, we actually calculated where is the average, viability for us, between our two markets and between market and off market. So, for marketed deals, we're probably 7%, 6% closer on average than for off-market deals. So you can see in the off-market, both Houston and Dallas were like, in the 70s, which is pretty far off. And for marketed deals, we're closer, 80, 84. And I think part of that also is, you can see actually we're closer on Dallas at the moment, which is surprising because, of course, Dallas has been a hot market and very competitive to bid in. So it's kind of interesting to see that that difference there. But so that sort of goes to actually our next insight, which is about this cap rates, which is that the cap rates on average actually seem to have compressed. But you can see that they've compressed for us in our underwriting, more in Houston from Q4 to Q1 than in Dallas. So, Dallas, we made the asking cap rates last quarter 3.8, and then this quarter 3.6, on kind of adjusted expenses and everything. Whereas in Houston, 3.7 and 3.3. So Houston's for 40 bips tighter. And why is that? So because in Houston, expenses are going up. So insurance is going up. That's probably the main driver there. And so that's kind of, so you've seen the cap rates tighten in Houston because the pricing hasn't really kind of fully adjusted to account for the increased expenses. So that's also affecting transactability in that market.
This was a surprising insight for me because I'm under the impression, like many others, I'm sure, that cap rates have expanded and are due to continue to expand as the market adjusts and digests higher interest rates. So to see cap rates in both markets become more compressed, that is interesting. And also the interest rates that were in the market during Q4 versus Q1 were roughly the same. We started Q4 with lower interest rates, and then interest rates went up and up. And then the opposite happened with Q1, where we started with high interest rates and then they kind of went down. So I think the average is somewhere around the same. But just to recap, where we had pretty much the most aggressive market here ending in Q2 of last year. And so you see we had low 3 cap rates, and then we started expanding, we continued to expand. And I figured that we would see even further expansion here into the 4s, but we didn't have that. So as Charles explained, it's, at least in Houston, it's arguably mostly due to rising expenses. And this is us adjusting to the market. And you could say, well, we could have inputted these higher insurance costs back here. But so it's not necessarily tracking chronologically perfectly, but at some point, buyers in the market are recognizing future higher costs, and that's weighing on their cap rates. And it's going to take time, even longer time, for sellers to accept that fact and go, okay, fine, and go out with lower asking caps, right? Sellers don't overnight change their pricing expectations. So that's why it's a long, slow moving process that we have here.
Yeah, it takes, so we might have started adjusting our insurance number before the market at large, and it takes some time for the market at large to cycle through that expense, that insurance renewals, for example, and it really kind of hits the reality there.
Yeah, and then let's also look at asking cap rates versus our cap rates.
Right.
And talk about, and what is the difference, just to recap. So the asking cap rate is the strike price that the broker is and the seller are offering the property for. That's what they'd like to sell the property for. And LSC cap rates are the cap rates that we would like to buy for, right? So here you can see peaked in Q3, or no, I'm sorry, peaked in Q2, just like asking cap rates. And then we started to expand and expand because we are moving with interest rates. That affects our underwriting immediately, right? Underwriting is obviously very sensitive to interest rates. And then here we are in Q3 versus Q1, our cap rates actually went down. So can you explain that?
Well, I think, we're also working on, in Houston, I think there's part of it is that these are average numbers. And so there might have been a number of sort of troubled properties that bring that average down, specifically in Houston. But I think it's also interesting, you can see that kind of that bid-ask spread it's widened since, Q2 of last year, when basically, it was very hot, there were lots of market processes, lots of action all the time. And then you can see that, we and many other people as well immediately have widened our cap rates back in Q3 of last year. But then you can see that the asking cap rates in both markets have kind of trickled along much slower in terms of, they haven't reached anywhere near that, bridging that gap, right? We went from 3.6 to 4.2 today, which is 60 bips. They've gone from 3.2 to 3.6, which is 40 bips, and they're starting from a lower point. So it's just, the movement of the market cap rate has been slower, and so there's just been less activity for the last 3 quarters.
Yeah. Do you want to cover these next?
Sure. I mean, yeah, so this is kind of an extension of the bid-ask discussion, really. This just shows kind of how the deals are pricing in terms of our price versus the ask price. And then at different, what percentile of our pricing are we at versus the ask. So, how transactable is the average deal? Well, the median deal in the most recent quarter, we were at 80% of the asking price, which is, the bid-ask spread is widened for us. So the table below, the Q4 metrics, you can see we were 85% for the median deal last quarter. So, the pricing's kind of continued to get a little tougher in terms of transactability, at least for us, on average in the deals we look at. And you can see the same thing about the median deal, because the average numbers for cap rate and such can be a little, difficult to make sense of. But, you can see we want 4 cap in the median deal that we're looking at, which has actually stayed the same.
Yeah, which is interesting. Meanwhile, the IRR has gone down, and I think that's probably just due to financing, I'm assuming. Right, cap rate the same.
Actually, I think we're slightly
just more aggressive.
Yeah.
Okay, let's take a question here. So Elijah's asking about off-market deals. What does our process finding these deals look like? What have you said to unreasonable price sellers? So, I mean, as far as want to just talk about sourcing.
Yeah, I mean, we just try and keep in touch with brokers. We're always in touch with them, whether for market or off market. We try and participate in everything. Want to be first call, or we want to get the shops. We tend to just feedback our pricing, and a lot of the time these days, nothing really happens.
Yeah, I mean, it sounds like you're asking for some sort of secret sauce. I would say we have no sort of secret sauce as far as dealing with unreasonably priced sellers. I mean, the market is the market. We can't convince a seller. So it's just, this is the reason why we look at so many opportunities to find the right ones and provide feedback to the market. And as far as when we talk about off market, we're very rarely talking about direct to seller opportunities. Almost none of them are direct. I mean, maybe out of this quarter of 100 deals, maybe 2 of them are direct to seller.
I think, two to 4, maybe.
2 to 4.
Yeah.
So yeah, when you're talking about institutionally sized properties, 20 million plus, very, very rarely are you going to get a direct to seller opportunity. So that's not even something that we're really chasing. Most of the time it's a waste of time. We've never bought directly from a seller. Let's go and talk about Patrick's question about how we approach the value add component and how that's estimated. So that's actually a really good point, because we can now flip from talking about asking cap rates and our cap rates and actually more focus on yield on costs. So where should we go in the table for that?
Yield on cost. Well, yes, yield on cost is going to be this column, and then there's one for the at their pricing. Because the yield on cost is going to be based on our projected stabilized NOI. So that's the column that's just off the screen to the right-hand side. And then over the purchase price plus CapEx. So that's what we have, CapEx in the table at the far right. So that gives you, that's used to calculate the yield on cost, in addition to the purchase price. And then it also gives you some indication of what kind of a deal it is, right? If there's a high number there, it's going to be more involved, and if there's a lower number, it's probably a bit more straightforward.
Yeah, let's explain that a little bit more. So there's a few ways to get, obviously the higher yield on cost, the better. And there's a few ways to get to a higher yield on cost. One of which would be just to buy a higher cap rate, right? A higher cap rate could get you closer to the higher yield on cost that you want. The other way to go would be to buy a low in-place cap rate. For example, you could buy a property that's half vacant, and there's a big turnaround play, but there's usually a big reward there by way of a higher yield on cost. And that relationship is actually something that you should demand from a deal. So you wouldn't just want to buy a distressed asset and achieve the same yield on cost as a stabilized asset. You would want a premium there. And so we can find examples of that. For example, I would like
That one, yeah.
Like this one. This one, we've got a deal here that has basically a negative going in cap rate and a yield on cost of 6.8. So that is not necessarily a good deal, because what this seller is basically asking for is for you to pay stabilized pricing for a distressed deal that has no income.
And it's going to lose money.
And it's losing money, right? And it's your job to turn it around, but you're not even getting paid for your effort of turning it around, because all you're ending up with is a 6.8% yield on cost. So it's a big spread with not much of a reward. For an 8% spread between my cap rate and my yield on cost, we want to get paid more. And that's why you can see that in our underwriting. You can see we would actually want to end up at a 9.1%. I'm sorry, no. We want to end up at a 7.7% yield on cost to make it worth our while to pursue the distressed opportunity. So that's what yield on cost is all about. And so you can see the average yield on cost asking is 5.6%. And we are demanding 6.9%.
Yeah.
Big spread. That's a very big spread. So just going back to make sure Patrick's question is answered, right? Asking how we estimate the value component. So that gets more into our underwriting process, right? And less about the deal flow data. But, obviously Brad and Charles are doing rent comps and estimating renovation budgets.
Yeah.
And also, you want to talk a little bit about that?
Well, I mean, there are a few different ways, right? I mean, you could either, a lot of them, they just have a pre-package. They've already done half the units, and you kind of figure you can do the rest. Typically, you're not going to get tremendous returns for doing that, because everyone knows how to do that, and it's, whatever. But it is money that you can make for doing something that's relatively straightforward, and you do get paid to do it, generally, or at least will demand to be paid to do that. But there's also obviously the comps have to support it. You know, you're going to put the money in to renovate the units. You have to figure that you can get rent premiums if every deal in your submarket looks the same. And they say that you should renovate, you know, every deal's got just the plain old regular countertops, and they say you should put granite in, and nobody else has that, and nobody else has higher rent, then you might be skeptical. So you wouldn't do that plan. But I think in this chart, you know, you can kind of see that somewhat in the, you know, our IRR metrics and the CapEx budget, basically. So, you know, deals that have more value add component are going to have lower going in cap rates. They're probably going to have higher project IRR and unlevered IRR, and they're going to have a higher CapEx budget in terms of the deals in this chart. And likewise, yield on cost will have a higher yield on cost.
So let's address Matt's question, which is a very popular topic these days, which is positive leverage. So Matt asks, have you been seeing any opportunities these days with the ability to employ positive leverage? So let's actually do a filter here on the underwritten cap rate, and let's go by descending order, right? So if we look at the absolute highest cap rate that we saw in the market was a 5.8 cap. So there, if you bought that deal, you would be able to actually acquire it with positive leverage, because you could use agency financing in today's market where treasuries are today. You could do a 5.5% rate all day long, and that would be positive leverage. So, but as we start going down the list, you can see the vast majority of deals are below mid-low fives, right? So we've got a lot of negative leverage. But then you have to ask yourself the question, when talking about positive leverage, are you limiting yourself to only being positively leveraged day one, or are you comfortable being positively levered on a stabilized basis, right? Meaning yield on cost. Because what if you buy today at a negatively levered position, but then in a year from now, through your business plan, you're able to push NOI such that you become positively levered, right? That's a risk question. It's something that, are you willing to take the risk on the business plan to get to positive leverage? So everyone's talking about positive leverage these days. Go ahead.
Well, it's good to undo to get the chart back to what it was. Yeah. Well, I think. Yeah. I mean, I don't know. I think in terms of positive leverage, historically never really been available.
Yeah.
Because I mean, that would basically just be free money. I mean, that generally you're going to buy with the expectation that, I mean, there's generally market rent growth. So that would be a reason why you wouldn't be able to get positive leverage ever going in, you know, and generally you're going to expect to be able to do things a little better than the next guy or whatever. And also in terms of our product, you know, we're looking for high returns, value add, this kind of thing, right? If you wanted to be able to buy with positive leverage, you'd probably be looking at, that's a deal that makes sense going in. It's probably going to be a cash yield type deal or something, and not going to achieve the kinds of IRR targets that, you know, certainly our investors are looking for.
Yeah, because there's an inverse relationship between underwritten cap rate and yield on cost. Generally speaking, the higher buy, the lower the yield on cost is going to be. And hold on a second. So that's like Charles was explaining, if you absolutely have to have positive leverage, well, that might force you to buy, it will force you to buy a higher cap rate. Well, where are higher cap rates? Higher cap rates exist on deals that are in worse condition, in worse locations, in worse markets, worse asset classes, right? Maybe non-multifamily, you could get a higher cap rate, as well as having less upside. The more upside a deal has, the lower the going in cap rate. So if you want to buy a higher cap rate, you would then buy lower upside. And also you maybe, if it is just a no upside deal, you tailor your financing and you do 10-year financing with yield maintenance, you'd be able to get the absolute lowest rate. And today that rate would be close to 5%. So if you buy, you know, good product with cash flow and you have 5% debt, now you're getting close, but still buying at a 5 cap today, unfortunately, is very, very challenging. So that's a good question about yield on cost, or I'm sorry, about positive versus negative leverage. What else do we want to talk about?
Well, I guess, I mean, on the kind of the business plan aspect, from quarter to quarter, our business plan has just got a little bit less aggressive. So, it's a tighter market. We're stretching a little bit less. So you can see, our CapEx budgets have dropped just a little bit. Also, some sort of COVID pricing falling out of materials costs maybe, but from 9,300 to 9,000. And then similarly, our underwritten IRRs have fallen just a little bit. So we were, 15 that we want.
Where is this IRR? I'm seeing
14.
21 to 20.
Yeah, 21 to 20. So
unlevered. Yeah.
Yeah. So unlevered, 15 to 14. So we found like a point kind of on our underwriting there, with less budget. So I think we're slightly backing off sort of the operational risk a little bit in our plans.
We're favoring deals that are lower risk, I think, because the market is in a situation where if you want to take a lot of risk, you can, but the projected returns don't really go up much for that. So you may as well focus on the deals that are less risky and where the outcome is more certain. And that results in targeting slightly lower returns, as well as targeting deals with slightly smaller budgets. And also, as Charles mentioned, some of this decline in renovation budgets could be due to relief from increased costs associated from coming out of COVID. Here you can also see where it's projecting, really really small differences here as far as the projected NOI per unit being a little bit lower.
You also look at the rent growth assumptions probably being a little lower.
Right, being less aggressive with rent growth, as that's starting to slow down a little bit. We're still seeing in our market still positive rent growth and still strong renewals. So performance remains strong.
Also our exit cap underwriting has, widened from 5.5 to 5.6, even, since the beginning of the year. So we're continuing to be a little bit, wider on that. Obviously, a lot of the adjustment would have been last year already.
Yeah, I would say average exit caps towards I'd say in Q3, Q4 of last year were kind of around 5. And now we've widened exit cap rates by about 50 basis points. So that would probably be the single biggest thing that is affecting our underwriting. That and debt, right? Debt obviously has especially because leverage is lower today, that's having a lower magnifying impact on levered returns. And then when you factor in a wider exit cap, that just really penalizes your numbers and makes your return projections much lower. Charles, Skylar's asking, how do we determine exit cap rates?
Kind of what we think that, reasonable would be to buy plus a little bit, I guess. So maybe call it 25 to 50, depending on the deal. Of course, to some extent, this answer depends on your view on interest rates, but I think we definitely want to at least see some expansion over where we are. So probably 50 bits of expansion.
We're certainly not trying to predict the future. We're trying to have good underwriting fundamentals, and good underwriting fundamentals means that you have a slightly higher exit cap rate than what is currently observed in the market. And so today there is not much of a market to begin with. So cap rates, it's really what people are talking about at the institutional level. And it's precluding a lot of institutional investors from investing because they just don't know where rates and cap rates are going to land. So it's hard for them to underwrite terminal value, which is an exit cap rate. So it's funny, it all comes down to this. And right now, I'd say we're seeing market cap rates for deals. Not much is really actually getting sold, right? So it's really hard to say what is the true market value, which then leads you to, so I guess for Skylar's question, right, in a normal market, how we've been having things, there's tons of trades. And through this very document, through this trade tracker that we call it, we would see, very simple. The average asking price, guidance pricing cap rate is right here. It's 3.4. Okay, so the market cap rate is 3.4, and then we add 50 basis points to that, or maybe about 100, because these are value add deals. So these aren't stabilized market cap rates. So you take that 3.4, you go to 4, and then you exit at 4.5, and there's your exit cap rate. But just because people are asking for 3.4 caps today, that doesn't really mean where the market is. The market is definitely not that low. So we have a more ambiguous market. So then you say, well, is there another way to come up with exit cap rate valuation? And another way to look at it, for example, a private equity firm I was speaking with, their argument was, well, the historical spread between the 10-year treasury and cap rates is roughly 200 basis points. And if we have a 3.5% treasury, then cap rates need to be 5.5%. And then if you want to be conservative from there, you could say, okay, well, 50 basis points above that, now you're at a 6 cap. And then, now today we look at the market, 10-year treasury is more like 3.2. So do you adjust it down, or do you then put your macroeconomic hat on and guess essentially where the 10 years going to be when you sell in 5 years, right? So you say, well, I think that the 10 years is going to be at 3% in 5 years time, and the historical spread is 2%. So it'll be a 5 cap, and we want to be 50 basis points wide of that. So 5.5, right? I mean, there's so many ways you can come up with reasonings. I think at the end of the day, you just have to do something that is defensible, rational. But if you just slap a 6 cap on it, it might just be too pessimistic, and you'll never buy the deal. So it's just always this balance of being aggressive enough to give yourself a chance to buy, while not getting over your skis and being too aggressive, obviously.
And market cap rate, it's not just determined by interest rates, right? I mean, there's the spread can vary. So I mean, even if you have an interest rate view, that doesn't necessarily mean that your exit cap should just kind of move in tandem with interest rates. There are fundamental drivers of the supply and demand in the market, the capital market, all this stuff that also influence it, inflation as well. So there's a lot that goes into it in the end, and it's sort of you have to kind of have an opinion.
Okay, so I think unless you have anything else, I'm gonna basically throw out there, if you thought things were going to get better this quarter, they didn't, right? I think we still have some time to go. I guess here would be a good place to point that out. From Q3 to Q4 to Q1, cap rates are still remaining low, making it very difficult to transact, as I'm sure you all are seeing. Not a ton of deals are getting done. And I think we have a couple more quarters of that, but who really knows, right? It could get back to business quicker with a market sighing. If the market has a sigh of relief and the Fed signals the end of raising rates, that might really calm things down and allow things to go, or it could drag things out on, and investor sentiment could be negative, and that could delay things. So that is kind of what I'm seeing here, is that patience. It's going to take time for the market to work itself out to get to this point. Okay, so that pretty much wraps it up with what we wanted to share today. We have some more time if anybody wants to ask a question, in the chat or live, feel free to do so. And then from there, we will sign off and send the recording out.
Thanks, guys. Appreciate it. Will you be sending out the blank template with the recording?
Oh, thank you for reminding me. Do you have a blank template? We have a blank.
Yeah, we have one somewhere.
All right, we'll find the blank template for you right now, and we'll post a link in the chat. So that way, only people who are on the call get this blank template.
Awesome. Thank you, guys. Appreciate it.
Okay. Yeah. Oh, that's it there. Yeah.
Is this it?
Let's double check, but probably. I know that's.
But we could share this.
That's true.
All right. We'll
it's out of date.
Yeah, we have an out of date one to share. Okay,
Excuse
cool.
me. One question that I do have: are there any other? I've read your book. Thanks a lot. Very informational. Are there any other forums that you can recommend just to get a little bit more astute on the spreadsheet and all the various formulas that would, make, our acquisition template a little bit more sound?
Adventures in CRE has really good sound fundamentals and formulas and stuff like that to dig into their spreadsheets. I don't know. Do you have any other ideas?
REFM.
I'm not familiar with that one. What is that?
I think it's called REFM. I haven't done it myself.
REFM.
I think that's out there.
Yeah. So, I mean, obviously you've read, it sounds like you read maybe my first book. I'll just put those links in there as well. Let's answer this. This is a go-to question. So when we're way off on price, do we submit an LOI or just give feedback?
Yeah, a lot of verbals or emails, which is a verbal.
The brokers will sometimes ask for an LOI because they want to have something in hand to be able to show the seller and say, hey, this is what the market's saying. And they try to convince the seller with enough offers.
If we feel like there might be some pressure, you could also submit low and just hope that they kind of, get desperate one day.
Yeah, it's always good to have your LOI just sitting there and, they might pick up the phone and call you back. And then what about, Mina's asking, what about showing our underwriting? When we're super far off, the broker says, hey, are you, what's going on in your head?
Well, I mean, the underwriting is reflective of like opinions that you have, qualitative opinions, sort of, does it stack up to the rent comps? Does that make sense? Is the condition of the property good? Is our budget therefore going to be higher? So you might provide feedback on where your opinion might differ from, for example, the opinion of the buyer who probably is going to buy the deal. So like if they're telling everyone that there's a value add plan, then probably a buyer will come along, hopefully for them. A buyer comes along who's going to buy that, and if you don't believe it, you might say, well, we think the rent comps don't support this or something. But you probably just qualitative feedback mostly. We don't like the area or whatever.
Right. Yeah, it's all in the eyes of the beholder, right? They're hoping to find a buyer who falls in love with the deal and can overlook its downsides, but that's not obviously everyone, and it's not always going to be us. All right. Well, I think that pretty much wraps us up here. Thanks, everyone. Chris, you have
I'm curious. Yeah, I'm curious. I know, with the state of interest rates, in the single family arena, there's a big opportunity for creative finance, and a lot of people are trying to leverage that. I'm just curious, how much do you see that being a play in the large multifamily space? Not at all, or it just is a case by case basis?
Yeah, we've seen a little bit of it. I think Rise 48, which is a sponsor in Phoenix, they closed the deal in Phoenix with seller financing. So that's creative, and I'm sure was a home run for them. The other thing that's more prevalent in our space is mezzanine financing or preferred equity. So getting more creative with, instead of just having a bridge loan or having just one loan on the deal, you might have some sub debt or some sort of, like I said, preferred equity. So I don't think there's a ton of that happening as far as acquisitions, but I know that's definitely happening on recaps. So recapitalizations where people are doing a refi, and then in conjunction with the refi, they might be putting on pref equity as well, because they might have higher leverage currently, and they're trying to get into lower leverage, but they need to supplement that lower leverage, obviously, with third-party equity. And then maybe there's some equity buyouts happening as well, where you can use pref equity to buy out an equity partner. So I think that's the creative stuff. There isn't
assumptions. I mean,
yeah, loan assumptions are another good example.
They're a big portion of what's available right now and transactable right now, and you can maybe get a supplemental on them in multifamily from the agencies. So,
got it. Okay, cool. Appreciate you guys.
Very cool. All right. Well, thanks so much. And we will see you on the next one.